Hi, I'm Briscoe, Director of Financial Planning at Girard. Uncertainty and volatility in the markets is stressful and can cause some negative feelings like anxiety and fear when it comes to your investment portfolio and how it fits into your overall financial plan. My colleague, Mark Balser, recently shared insights on investing during times of market volatility. We think of investments as tools to achieve one's financial goals. Instead of leaning on our investments to bail us out for a lack of planning or budget, we think it's best to let planning lead the way to avoid the investment biases that inevitably get us into trouble. It's important to understand that of the many factors contributing to your portfolio and plan, there are just some that you cannot control. Market volatility, inflation, potential changes to tax policies, to name a few. And it's okay to acknowledge them, but instead of focusing on that which you cannot control, try to concentrate on that which you can control. I share some examples of what you can control here. They include asset allocation. One way to combat market volatility is to have an appropriate investment strategy. Finding that right mix of stocks, bonds, and cash for your specific risk tolerance can help you weather the ups and downs of the market. Asset location. Where your investments are can help you manage taxes. Holding more tax-efficient assets in taxable accounts like ETFs and muni bonds, and less tax-efficient assets in tax-deferred accounts like mutual funds, high-yield bonds, can help manage the taxes you pay each year. And finally, budgeting, which is saving and spending. Stay disciplined when it comes to how much you're saving and be cognizant of your spending. Review your budget to see if there are any opportunities to cut expenses and perhaps save more. If you're saving money, make sure you have an emergency savings account, or what I like to call a rainy day fund. You want to have enough set aside to handle those one-off expenses that can unexpectedly arise, or if there's an unplanned event like a sickness or a lost job. With an emergency savings account, you can avoid having to borrow, sell investments, or decrease savings to pay for those expenses, all of which can impact your financial plan and future. If you're working, 3 to 6 months worth of expenses. If you're retired or approaching retirement, maybe more, like 6 to 12 months. Find an amount that you feel comfortable with, then work to invest the rest. Concentrating on these controllable factors can help maintain financial discipline and navigate market volatility with greater confidence. So what can you do now? Focus on the long term. Turn off the news. While it's important to stay informed, too much can lead to information overload and enhance those negative feelings, one of them being fear. Speaking of fear, don't let fear make your investment decisions for you. In other words, avoid panic selling. And look at the big picture. Concentrate on your goals and not your monthly statements. And finally, revisit your financial planning. There's an old proverb that says, the best time to plant a tree was 20 years ago. The second best time is today. Same goes with a financial plan. It's never too late, and it's crucial for your long-term success. Maintaining financial discipline in volatile markets can be challenging, but having a comprehensive plan can help reduce stress and anxiety, as well as provide clarity during times when things seem so unclear. Remember, your financial plan is constantly evolving and adapting as the environment and your situation changes. And while you should be aware of and plan for the factors you cannot control, it's important to remain focused on what you can control and, more importantly, the things that matter in your life. Stay calm, stay disciplined and diversified, stay the course. Thank you for watching, and thank you for trusting Girard for your wealth management and financial planning needs.